For the latest in strategic affairs, subscribe to our YouTube channel. Click the bell icon for more updates.
Did you know that the stock market capitalization of the Indian stock markets rose from $55 billion in 1993 to a staggering $3.7 trillion this year? Did you know that the National Stock Exchange, or NSE, is the 9th largest stock market in the world? Hello and welcome to another edition of Capital Calculus. I'm your host Anil Padmanabh. A few weeks ago, the Nifty 50 index crossed a record 20,000. Undoubtedly, this was a very significant milestone. More importantly though, the Nifty 50 is considered to be the bellwether of the Indian economy. What then does this surge of this index tell us about the new India story? To answer this and more, we spoke to Srinivas Jain, his Executive Director and Head of Strategy at SBI Mutual Fund. Srini, as he's popularly known, is a keen watcher of the Indian economy and the stock markets. I began by asking Srini to share his thoughts on the Nifty 50 crossing Mount 20,000.
Yeah, it's, I would say it's not a number, right? 20,000 is a number, but I would say it's not a number. It feels more like, Sachin Tendulkar hitting his 100th international century. It basically encapsulates years of hard work that he has put, all the strategy and the resilience that's gone through that. It is a landmark moment. It's akin to the Indian economic coming of age, I would say. And it's also testament to a lot of untapped potential that we are just about beginning to realize, that's going to play out in coming years. So it's more than a number. It's a kind of a statement, the 20,000 mark being hit.
See, unlike Sachin, this is a little bit of a skewed record. The first 10,000 took 22 years and the next 10,000 took 6 years. So what does that tell you?
Well, it tells you the similar cricketing analogy. 22 years is a test match. So you take your sweet time. The initial overs are the foundation layer that you build. And then in the last 6 years, you see the acceleration that's coming. It's the similarity, I wouldn't say T20, it's more a one-day kind of a format. I think T20s are something that's going to come up. So I think that this kind of what we call as a hockey stick growth curve is basically what we are now kind of seeing in India. There is a post-liberalization period. We found ourselves into that footing, and that took a while. Then you saw that IT boom period. And then, of course, now with all the large reforms like GST and digitization and all that stuff, they have become the catalyst. So you see this big uplift. It's actually coming from many large catalyst programs that have all happened in a very, very short span. And that's kind of paying off to that. So I would say, people say the warming up period is over. Now the economy is on a fire kind of a period.
So what you're saying is that it's in many ways mirroring the economic transformation that we have witnessed in the, say, decade and more. So it's kind of percolating down to people and they are also participating, or is it that these are investors, wholesale investors, etc., who are driving this market?
No, it's a very broad based. There has been, of course, India has seen very good retail participation in the past, but those retail participation kind of dwindled when the markets had not done very well for a sustained long period of time. Today, the confidence level is far more better, and then of course you have seen a whole new set of new investors who've come into the market. And they are kind of experiencing the market either directly through the equity market. You see a boom in the demat accounts being opened. But I think it's also the boom in the mutual fund industry, the way how much of investments have gone through the mutual fund industry. So it is diversified. Of course, the institutional investors are also investing. The big ticket players are also, HNIs are also big players in the market. And more importantly, you have the foreign capital That's come in a big way in the last decade or so. In fact, in the last year, they've seen record flows from FIs.
So what you're saying is the investor mix has become more kind of not skewed in one way. It is more balanced, is it?
It is getting balanced. It's not. It's still skewed. The big money is from large investors. So in India, if you see the kind of the holding pattern, it's basically the promoters and founders who hold the large chunk of the equity market, and then there is FIIs, domestic institutional investors, and then retail investors. But the retail investor segment year after year is actually going up. So you see that kind of a much better harmony. You need big money to access capital market, but big money can also come from small investors, and that's kind of happening. One of the big things that we saw in the last 5-6 years is the participation of EPFO. And EPFO, unlike mutual funds, is actually a consolidation of a lot of retail investor, 8 crore plus investors. And their funds are now getting invested in the equity market. So you may call them institutional because they come as an institutional, but behind that institutional is a whole lot of retail investors. So the benefit of all of that stuff is going to retail investors.
That's interesting because EPFO, when it started several years ago, investments in equity, it was an enormous hue and cry. That noise has waned, right? I mean, now it is par for the course for the EPFO to do this.
Yeah, absolutely. It was untested territory. While I think all over the world, retirement funds have been investing in equity because that's the only way to make long-term wealth. Because especially if it's retirement money and you have the luxury of holding for a longer period, there's nothing better than an equity category to invest in. However, in India, we've never tested that. So there was always this skepticism saying it's hard-earned money. What happens to it? Thankfully, now we have some track record to show that equity has done well, and they have taken largely a Nifty Sensex kind of a view, and they've actually given a booster return in the last few years to their existing portfolio. Their exposure is still very low. It's still a small percentage of incremental money that's coming here, but that can go up, and eventually that will go up. And we see that in NPS too, the new pension scheme. You see a lot of investors coming in there. There also people are choosing the larger equity component of the schemes. So it is overall, I mean, it started off with the boom in mutual fund industry, which continues to be the biggest contributor to the equity market beyond the FIs and promoters. But now you can see other institutional investors backed by retail investors coming into the market. So I just wanted to tell you that it's also not like a one-time thing. One of the things I wanted to talk about is the SIP investors, and we talk about SIP every time. But just last month, we crossed a large milestone. SBI Mutual Fund alone, we crossed a 1 crore active SIP. That means every month, 1 crore investor, month over month, is giving us an investment with us. This is apart from your regular investor. This is a big number. Industry has about 7+ crore such folios. So it's a big number, right? So in terms of money coming in. And that's also helping not just, keep the buoyancy in the market. More importantly, the wealth effect, right? It moves. All that money is now going to masses than just set of institutional investors.
So, Srini, just staying on that, how do you democratize this further? Because right now, you're talking about middle class, but how do you go beyond the middle class, the emerging middle class? Those are come out of poverty and are looking to save and grow their resources.
No, then it's a good question. You need to be a little more careful in not overdoing that segment. They have very limited disposable savings. So we got to be careful in terms of what is the right product approach there. Having said that, some kind of a collective scheme where the risk is kind of distributed, which will help those people. Because, if your disposable saving is very low, taking a risk in that itself, because you're already in a foot-to-mouth kind of a scenario. Having said that, there is a big chunk of people who've not even experienced equity, who have significant disposable saving, who've been with traditional investment avenue. That market runs in crores and crores of investors. There is a potential for better education, more exposure. And we have this SIP kind of teaser products. People can come in with a small amount of money get familiarized with the market experience, and then of course build over a period of time. Once you build that confidence, you can do a better job. Of course, people have to stick to risk disciplines and investment disciplines in terms of asset allocations. Once that is done, I think this is going to be a big lever in terms of bringing in more and more money to equity market, and hence distributing the wealth to a much larger segment of people.
So far, we have come to learn that the Nifty 50 is the go-to index for both the regulars as well as the first-time investors. I was curious to know as to why and how the Nifty 50 has emerged as the bellwether for the Indian economy.
When you look at Nifty 50, there are some concentration when you look at it from an overall perspective. But I think it's a well-balanced thali, I would say. You still have a lot of ingredients that's available. It is tilted towards financial services overall, but it still has financial services, pharma, traditional companies, technology companies. So it has everything, like a thali, a protein, carb, fat, everything is available. I think the diversified nature of Nifty 50 gives it that so-called proxy effort. It's not just one industry that's doing well, which is taking Nifty 50 up. It is a segment of industry. There are some industries which have higher weight, financial services for one. But I still feel it's a good barometer to talk about the Indian economy. It kind of captures the essence of what's already happened and potential that is likely to happen. One of the things about Nifty is kind of it's a lead indicator of what to expect, because people are putting in money with expectation rather than past return. So that's something that you can say. That's a fair claim to say it is a proxy to the health of Indian economy.
So what is your sense? What are the investors expecting, looking, say, 5 years ahead?
Investors are expecting a lot, but I think what investors should expect is an important thing. I think we need to, it's not to say that people won't make similar return like they made before. They could. But the point is that we've now come to a level where the risk trade-off or risk returns or risks that you take and the return that you get on is obviously going to get narrowed as more and more number of people participate. There are still going to be tons of opportunities to make money in the equity market. But to expect anything between the risk-free return anywhere between 4% or 5% above that is, I think, a very good expectation for investors to have. You won't probably think about a 15-20% return on a structural long-term point of view, but in early double-digit numbers are going to be there, especially considering if you take a decadal change, you will have a lower interest rate kind of scenario. The alternative to this would be in low single digits. So obviously, equity is the way to go, and that's the way to investors to invest.
So Srini, if I'm not mistaken, most of these 50 scripts in the Nifty 50 are large cap companies, right? So what does this big surge in the Nifty 50 tell us about these companies? Obviously, people are betting on them, right? So why?
Yeah, I mean, they're betting on it for two reasons. One, of course, large cap companies have potential to take more capital because there is an ability of liquidity that's available on them. And mid and small cap don't have such large trading volume. So to that extent, there is more money coming in, actually goes in for more liquid stock. And there is also this effect of ETFs and index who kind of largely bring money to Nifty, Sensex kind of money, because that's the way it's been around. Also, the fact is these large companies are like the IITs and IIMs of India. You will still have a lot of colleges out there, but when you want to go, you would want to go to the star blue chips. They are the segment. So the performance basically of this is I mean, the way to look at it is that if you think about if I'm a first-time investor to the market, I would pick this compared to even mid or small cap. But I think once you start maturing with large cap, that is when you will diversify. Today, if you see even FIIs who've been very large cap investor for many, many years, I've started looking at down the market cap curve, but in a small way, but because of liquidity concerns, they've also started looking at it. So yeah, today right now it's like a magnet. This is like everything is getting attracted to this Nifty 50 Sensex stocks and maybe up to BSE 100 stocks. But over a period of time, you will see more participation. And one other way to do it is the composition itself is changing, right? Nifty itself is adding a lot of new stocks, getting new segments coming in. There are sectors with one IPO, they will get into a big index overnight. So these things are happening. So it's not going to be very static. It's going to be extremely dynamic. So it doesn't matter whether it's a large cap or not. There'll be another large cap which will be probably introduced in coming years that will also get into the index.
I couldn't let Srini go without sharing his advice to the growing tribe of first-time investors in India's stock markets, some of whom are also viewers of the show.
It's always important that if you have the trading mindset, you can and ready to lose money, you should go and invest in the market. And I see many young people saying, I would like to do that. I just feel that's not the right approach. I think education driven through experience is the best way to do it. Mutual fund SIPs are the best way to do it because you're diversifying your risk. The second best way to do is through ETFs and index funds, where you can, again, get the market benefit without putting extra efforts on where to invest. Once you understand when you have a level of confidence and the time that you can do well, that's when probably you need to think about opening a Demat account and trading on it. But the fact remains that, you must have seen the SEBI data too, that 90% of the people who trade in the market don't make money. Money is not made by trading, it's made by long-term investing. So betting on a good sector stock with a thorough understanding and research is critical. So for majority of the investors out there, I would always say go through a portfolio kind of capability, where either through mutual funds or any other way. But to those people who really have time on their hand, significant ability to time the market, they, I think, can definitely look at directly investing in the equity market. But that the wisdom all over the world is that segment of people are going to be very small. For the common man on the ground, I think it's better to stick to investing through more tried and tested methods, funds, ETFs, such kind of structures.
Indeed, that is sane advice for all first-time investors in the stock markets, especially since it comes from someone who heads strategy for India's largest mutual fund. The SBI Mutual Fund's footprint extends beyond 90% of India's PIN codes. The rise of the Nifty 50 tells us of the good times to come, especially since stock markets always bet on the future. It is also a signal that more investors are likely to join the party. Thank you for watching. Don't forget to subscribe to StratNewsGlobal on YouTube. Hit the bell icon so that you don't miss any updates. And please, to share your thoughts, ideas and suggestions with us, I'm available on Twitter at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.